Another record-breaking inflation print came out in US last week, 7.5%, highest in the last 40 years since 1982. But there are few differences between in 1982 and now. Number one, the interest rate was much higher in 1982 compared to right now, which is pretty much 0%. And if you look at the yield curve, it shows that we were actually in recession in 1982, versus now we're actually approaching a recessionary period or economic slowdown. So in this video, I'm going to cover what is a yield curve and how this is an important parameter to predict any potential downside in the economic growth or potential risk in terms of going into recession, and how interest rate is linked to pretty much everything in the economy. So without further ado, let's dive in. If you are new to my channel, my name is Yasin Nizami and I make these videos to educate my audience about real estate market in Canada, macroeconomics, financial education, general investing strategies, as well as technical sales. So if you are interested in any of these topics, feel free to subscribe so that you don't miss any future content. Now get back to topic of the day, which is yield curve. But before we go into yield curve, let's understand how interest rate linked to pretty much everything in the economy. Now I'm talking about the Western economies, predominantly in US and also in Europe. If we focus on US for the topic of the discussion, I think that will be helpful for you to understand. Now if you look at interest rate, when we hear interest rate in the financial news media, they are referring to the overnight rate set by the central bank of the country. And that is actually influencing the short-term rate in terms of the bond market. So let me break it down. So interest rate at a high level, generally, if it's kept low, it drives the economic growth in a way that, it makes the debt cheap, money cheap, and people tend to borrow more money to either for consumption purposes or to invest into other initiatives, whether this is corporate lending towards expanding businesses or residential investment in terms of mortgages. It drives the economy, it drives the consumer behavior to spend more money into the economy, which actually contributes into economic growth. On the other hand, if the interest rates are set high, it actually makes the money scarce. It makes money expensive. It makes debt expensive, which means less people will take, borrowing, less people will take money, both from the consumer side as well as corporate side. And that means less economic activity in the country, which drives towards economic decline in terms of growth perspective. So that's how generally the interest rate, relates into the economic growth in any country. Now let's talk about how this impacts stock market, especially in US. When we see the interest rate are kept low, this drives, as I said, behavior to take more money, more loan in order to either consume or invest into other initiatives. From stock valuation perspective, corporations typically use these opportunities to pay dividends to their stock holders, or buy back stocks, or do some investment into other business initiatives that increase the stock valuation overall. So whenever you see the interest rate is kept low, you will see the stock valuations are higher, and that's the inverse correlation between the interest rate and the stock valuation. On the other hand, if the interest rate are set higher, that means less capital available either for consumption or expansion perspective. That means less dividend being paid. That means less buybacks opportunities for corporations, which actually contracts the stock valuation. And you can see, whenever this interest rate starts going up, the stock market starts crumbling down. That's what happened in the last month or so. Since Federal Reserve announced tapering and hiking the interest rate, the stock market is in turmoil, right? The market is pricing in. They're trying to take their money out and trying to invest into other initiatives where they think there will be a probability of higher return. Housing is another sector which is also impacted by interest rate, as we have heard, and I think I pretty much talked about many times on my video channel, that interest rate drives the mortgage behavior. So if the rates are low, mortgage is cheap, that drives the housing activity. People tend to take more loans, more borrowing, that drives up the asset prices or housing prices up. On the other hand, if the rates are going up, mortgage becomes expensive, debt becomes expensive. It is harder for people to pay back interest payment because the rates, the interest rates are much higher. That slows down the economic activity in the housing sector, which means less amount of houses being sold. People tend to not afford houses, anymore as they used to be in the low interest rate time. So that's how the interest rate and the housing activity, inversely correlated as well. Talk about gold. So gold is not directly linked with the interest rate, but it has an indirect impact on the gold market. For example, if you take the example of the stock market, when the interest rates are kept low, the stock market it grows. The stock valuation props higher. But as soon as the interest rates start hiking up, the investors tend to get nervous. They tend to take the money out of stock market and rush towards safe havens, which is typically gold, because gold has been around for centuries. It has been a real tangible asset, inflation hedge, and it has kept its value over centuries. So investors, when they think the market is in turmoil and the rates are going up, which means there is a sentiment in the market where investor will take the money out and invest somewhere else, and that somewhere else is most of the time is gold or silver or any platinum metal. That's how the gold prices fluctuates as the interest rate goes up and down. Now go back to the topic of this video, which is yield curve. First of all, the yield curve, in order to understand that, you need to understand the bond market, the way the bond market works in US. Basically, bond is a loan contract that the government or the corporation actually signs with you, the lender. So if you are the purchaser of the bond, so you are basically a lender, you're lending money to a government or corporation in exchange of bond contract. And you have basically the short-term bonds like 3 months, 6 months, 1 year term bond, and then on the other side of the spectrum you have long-term bond. For example, 10 years, 20 years, 30 years, 40 years. And if you plot the yield of these bonds on a graph like this, so if you look at this graph that shows on y-axis you have yield of these bonds, on the x-axis you have the maturity, which is the term of these bonds. Now yield means the interest or return on these bonds. So when you purchase a bond, you actually get paid not only your principal at the end of the maturity, but also the interest on these bonds. So that interest on these bonds is called yield. Okay, so when you look at this graph, you can see the short-term bonds have lower yield or lower interest rate versus the long-term bond, and that is self-explanatory, because the longer the term, the higher is the risk. Okay, so if you have a 10 years, 20 years, 30 years bond, you have a higher risk in terms of inflation, or the issuer become default at any time, so you have a much higher risk keeping those bonds over time. That means in order to compensate that risk, you get higher interest paid on those bonds versus the short-term bond, where the risk is much less as compared to the longer term of the bonds. That's why you see the yield in a normal economic condition will always be lower for the short-term bonds compared to the long-term bonds, which yields higher returns. Now in a healthier economy, the yield curve looks like this, but in a situation where we are approaching a economic slowdown or potentially a recession, this yield curve can go inverted. Okay, so what does it mean by a yield curve can go inverted? Well, let's assume if the short-term bonds start paying higher yield compared to the long-term bond, then this curve will become inverted. Okay, if that happens, we are actually going into a potential recession, because if you look at the yield curve graph, let me show you that. So this is the difference between a 2-year treasury yield and a 10-year US treasury yield, and it is plotted over this 50-year chart. And you can see the gray lines are showing recessions happen in the last 50 years in the US. Okay, I'm not talking about other markets because it's different if you compare this outside US, for example Europe or APJC, but in US it has been pretty much predictable. Whenever we have seen the recession, it was preceded by a yield curve inversion. Now this graph, which is basically a difference between the yield of 2-year treasury and 10-year treasury, it is showing as soon as it go below the zero line, which means it is getting inverted. The graph, the yield curve is getting inverted, and whenever it happens, you see this gray line. This is the recessionary period. So it happened in 1980s, right? This is where we are comparing today's inflation with. Then you can see in 1981 again it happened, and preceded by the yield curve inversion. Then the next recession was in 1990. Again, it was preceded by the yield curve inversion, right? And then the after that 2001 recession, the dot-com bubble, again preceded by yield curve inversion. Then 2008, again preceded by a yield curve inversion. And last time it was approaching was before March 20. We know that what happened in March 2020. So, but because Fed came in and injected $8 trillion of liquidity in the market, that propped up the overall asset bubbles up, right? But now you can see we are climbing back down, right? So the difference between the short-term yield and the long-term yield is getting lower and lower and lower every day. So if it's gonna cross this zero line, that means we have much higher predictability or chances to go into a recessionary period or slow economic period. And what happened last week when the 7.5% inflation news came out, the yield of the US Treasury bonds, especially 2 years and 10-year Treasury bond, has been climbing up. You can see that. So this is a 2-year Treasury bond. Right now it is yielding 1.58%, and a 10-year Treasury bond is yielding 1.98%. So the difference between the two is almost 40 basis points. So that difference is actually reducing every day. So that is a sign where we are thinking that the yield curve is likely to go inward. Okay, if it crosses this zero line again, we are going to have a much higher chance of going into recession and low economic growth. Now, I think because of all these dynamics, Federal Reserve has no chance, absolutely, other than raising interest rate as soon as possible. So I think we will see some interest rate activity potentially. I could be wrong, but this is my analysis and my assessment that they have no chance but to increase rates in order to stop going yield curve below zero line, which gets inverted. Hopefully this makes sense, and if you have any questions, put the comments down below, because I'm also doing my research. I could be wrong, but I would like to learn from you. What do you think what's going to happen in the next 3 or 4 months? How the US market is going to perform, because it will have a massive impact on international market, Canada, Europe, APJC, because if anything happens in US market, it will spill over in other financial markets globally. So I think we are closely watching what's going to happen in the US, especially the Fed reaction towards the rate hikes. So hope this makes sense and helpful. Give me a thumbs up if you like it. If you give me a thumbs down if you don't like it, I don't mind, but put your comments down below. What do you think about this? And I will see you in my next week video. Take care.